Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's good to be with you and with our listeners.
And also just remind our guests that Bob will be one of our interviewees on our weekend show, This Week in Money. So we get a double shot of Bob this week.
We'll handle it.
Yeah, but can everybody else? Bob, as usual, when we have questions from our listeners, we like to answer those first. Our first question is from Kate. Bob, I'm confused about the relative price action within the precious metal sector. With gold at or near its 2011 high, I would have assumed that the GDX Gold Miners Index would be at 60, not 41 as it is right now. And silver in 2011 reached nearly $50 an ounce, but stands at only $23 an ounce more or less today, less than half its 2011 high. Will silver and the precious metal miners catch up to gold bullion, or are these divergences related to hidden weakness in the underlying equity markets?
Kate, that's a good question. And I found the action in gold and silver relatively works out depending on where you are in the financial markets. And this contrasts with what the silver analysts do, and they look at supply demand, and they always know there's a shortage of supply, so therefore silver should go up. But underneath it all, you can call the gold-silver ratio a metallic credit spread. So in the good times, silver outperforms gold, and in the bad times, it doesn't. And this then explains why recently you have gold approaching highs, or maybe even making them, and silver not. And it's because in the recent crisis, the gold-silver ratio went up to 130. And this is traditional that in a boom, the gold-silver ratio goes down, and in a contraction, it goes up. And actually, it is one of our guides as to what could be happening next in the market. So in a post-bubble contraction, gold is the premier item, and gold stocks will outperform, and I also assume the general market, like the S&P, which it has been doing over the last year. But we wouldn't expect silver stocks to outperform because silver is not going to be the big play. It's basically underneath it. We've had a very good rise in gold's real price as deflated by the CPI. But also with this, you've had the deflated price of base metals decline after going up in the boom, and you also had the deflated price of crude oil decline after going up with the boom. Now, recently these have bounced, but this is just a bounce. So, anyways, I would say that silver and silver stocks are doing what they should be doing, underperforming gold, and this could last for a number of years. Now, this is not to say that on the next, actually, the precious metal sector really is overbought now. But on the next rally, there could be, good action in the silver stocks. But generally, gold stocks would be expected to outperform silver stocks, and this has been the case.
We have two questions from our good friend Mike His first question. Bob, this week, the U.S. dollar DXY index has been just below 95, about where it was on March 9th, just before it skyrocketed to nearly 103 on March 20th, coinciding with this year's equity market lows. March 20 also roughly coincided with a multi-month low in the GDX and a multi-year low in silver. Now it seems that the fantastic rally in the equity market since the March lows, as well as the outperforming rallies in GDX and silver, are getting a bit exhausted. Assuming liquidity problems resurface in the next month or so, when is it time to go long King Dollar, lighten up on GDX, and exit silver as we prepare for the next leg down in the equity markets? We await your reply to the first question.
There we are. Good question. Very timely. Yeah, our readings on the precious metal sector are overbought. And also, in that collapse in silver into March, took the RSI on the gold-silver ratio to exactly opposite to where it was in April of 2011, which was the height of that boom. And it's the action in, well, as we flip it the other way, the silver-gold ratio. When it got the RSI got up to 90, and I think it was April of 2011, we pointed out that the last time you had such outstanding action to drive the RSI to 90 was in January 1980, which was the top of that one, and we said it was dangerous and called for the bear market. And to have the opposite occur within a panic, as it did in March, was just incredible. It was wonderful symmetry, although devastating to the sector. And the RSI got down to 11, which is, hey, more or less opposite of being 90 in 2011. So on that was ending the bear market for the precious metal sector in real terms, also ending the bear market in relative terms against the big S&P formally. But for the last year or so, the gold stocks have been outperforming the S&P, which is what one would expect in a post-bubble contraction. So in part of the question is this, should lighten up on dollars now? And no, sorry, it's going the other way. The dollar index should stabilize in here for the next 5 or 6 weeks. And then if we run into some credit problems being discovered in the fall, the dollar would firm up. But strictly on its own, the action in precious metal sector is hot at about the time, like around mid-year. And you could lighten up a little on the sector.
Our second question from Mike. Are the silver bugs getting ahead of themselves? This recent 4-month spike in silver going from $12 to about $24 seems very similar to that silver spike in 2016 that ended with the silver bugs in tears.
Right. Yeah, we did cover a bit of that. Yeah, that crash into, I guess it was January 2016, was when crude oil fell from about 105 in 2014 down to 26, I think the low was. And that, of course, took precious metals down in silver. And then you had a bounce. That for the precious metals, in looking over our shoulder backwards, that then was a very, very sharp, short-covering rally, but within the context of a continuing bear market for the sector. And the reason why it was the underperformance was that the precious metal sector always underperforms in the final year or so of a bull market, of a great financial bubble. So technically that worked out, and the gold stocks have been outperforming the S&P for quite some time now, and this in itself is an indicator of a post-bubble contraction. Some of the best bull markets for gold and gold stocks have been in a post-bubble contraction. And it's mainly because the real price of gold goes up. And this is really showing up now. I see some of the standard metals analysts are beginning to realize that there's much more to the gold sector than saying that the Fed is crazy, it's going to trash the dollar, and gold's going to go to 10,000. And what has happened is that the price of crude has crashed relative to gold, and that represents mining costs, an important part of mining costs, or the cost of energy, whether it's the kind of electricity you need to turn things over, or the kind of energy you need to blast things apart. So anyways, I would say that things are working out as they should be, and that this will continue to confound the silver bugs. And thanks for the question, Mike.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're chatting with Bob Hoye. Bob, one of your headlines that we chatted about just before we went on air, Wall Street veteran says the rocket ship economy will blast the S&P to even higher highs. What's the story behind that?
Well, you had the crash due to the overbought in January, and then the most extraordinary shutdown of the global economy ever done in history. A lot of it done for political reasons relating to the Wuhan flu. So you had straight down, and as we pointed out at the time, severe liquidity problems in the stock market like that with forced sellings. It can generally run for about 2 months of intense down, and that then counted out to the end of March. And that's what we noted. So then you're going to get a relief rally. And, of course, the relief rally is technical. People had thrown everything out, and it was time for a rebound. So you had a V bottom in stocks, corporate bonds, commodities, that sort of thing. And then what this researcher is looking at is he assumes that there's going to be a V bottom in the economy. And what we looked at is that last summer, the U.S. yield curve, which is the difference between short rates and long rates, it inverted with short rates getting higher than long rates, and that is typical at the end of a strong expansion. And on our chart back to 1857 on the yield curve, every inversion has been followed by a recession. And then the curve inverted again in January. So you had the double inversion, and the last time you had the double attempt to invert at inversion was in 2007. And two critical times before that was in 1929 bubble and the 1873 bubble. So the credit contraction was set up, and our indicators all became very overbought on the rally into January. So our assumption was the market would go down anyways, and this was early January, but you wouldn't know the reason why the market went down until later. And of course, what happened is was the disaster with the flu, which made things the worst ever. But the main thing is if you look at what's going on in the credit markets, and that's the yield curve, and then also credit spreads, which is the difference between high grade and low-grade bonds, it is plotting out, or was plotting out, a turn to a cyclical contraction. And then the National Bureau of Economic Research, the NBER, said that the economy peaked in February, and we're now in a recession. So if you look at the disaster associated with the flu, it's not going to give you the clear picture. But if you look at the credit markets, it says we did a boom, and we're now in a credit contraction. So this is what we will watch. But there's this guy he's gone from the V bottom in financial assets to then assuming a V recovery in the economy. I don't think it's going to happen.
Canada's credit rating, according to Standard & Poor's, should stay at AAA, whereas Fisk downgraded it to AA+, I think. So does it really matter what these credit rating agencies say?
More so when it's a significant downgrade. And the federal government in Canada has been absolutely mad, crazy, insane in putting carbon dioxide ahead of our industrial and ahead of our resource industries, and then spending money like crazy. So I would expect there would be future downgrades in Canada's credit rating. And it'd be sad to see, but it seems that there's nothing you can do about the political power that is now sitting in Ottawa. Real things don't matter to them. So,
well, it was the father of the current prime minister who changed the way Canada borrowed money. Before, Canada used to borrow from itself until the 70s, when they decided, we'll throw some business to the commercial banks.
Yeah. Anyways, government is in bad hands, and eventually it'd be reflected in the credit ratings. So,
we'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, Asian corporate junk bonds are being downgraded at a record rate. What is that telling us?
Yeah, it's the problem with bond prices going down in a post-bubble contraction. It's not the threat of a return of inflation. Whereas in the 1970s, everybody learned that inflation was bad and it put interest rates up and bond prices down. But in a post-bubble contraction or deflation, the problem is not the threat of inflation, although lately a number of analysts are getting excited about it. But no, the problem is that there's so much debt written during the bubble mania that there's no way of servicing it. And that's the problem. Even if you had a flat economy, there's so much new debt that it can't be serviced. But then it forms part of the contraction. So the problem is not the threat of inflation. The problem is that debt will be very difficult to service. And then also on these great bubbles, most of the debt has been written in the financial center, which is New York. And a good portion of that debt is then due and payable in U.S. dollars into New York. So the huge debt bubble is effectively a huge short position in U.S. dollars. So this is where we are long-term bullish on the U.S. dollar because that's what happens to the senior currency in a post-bubble contraction. The line I like to use, Jim, is that the dollar will become chronically firm against most commodities and most currencies for most of the time.
Bob, thank you so much for doing the show.
Jim, it's good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.